Hey everyone, welcome back to Corporate Decoder, the place where we figure out if these corporate reports are secretly telling us the company is secretly drowning in debt. We're diving into the abrdn Global Dynamic Dividend Fund's latest filing today. Now, this isn't your typical company report. It is more about how a fund is operating and looking to raise more money. Think of it as a peek behind the curtain of how investment funds present themselves to investors. So let's see what is really going on under the hood before we jump in. If you appreciate getting straight insights from these complex documents, hit that subscribe button. And for more direct discussions and to connect with fellow finance enthusiasts, join our Discord community linked in the description below. Alright, so what we're looking at here is a prospectus supplement. Essentially, the abrdn Global Dynamic Dividend Fund, or AGD as it is sometimes called, is looking to offer more of its common shares to the public. The goal is to raise up to $25 million. They've got a distributor, Alabama PS Distributors Incorporated, and even a sub. Placement agent, UBS Securities Incorporated. It is all about them selling more shares directly. The price they're aiming for is around $11.53 per S-Hair, which is close to its net asset value, or NAV, of $11.48. That is pretty good. Actually, usually closed-end funds trade at a discount. So trading at a small premium, about 0.44%, is notable. Now, let's talk about what it costs to be a shareholder in this fund. There is a sales load of 1.00%, which is basically a commission for selling the shares. Then there are offering expenses borne by the fund itself, about 0.61%. For shareholders using the dividend reinvestment plan, there are a few fees. For example, if you reinvest dividends, there is a $0.02 per S-Hair fee for any open market purchases. If you want to buy more shares with optional cash, you could pay up to $5 for online bank debits. And selling shares held in a dividend reinvestment account will cost you $0.12 per S-Hair plus a fee of up to $25 for market orders. Looking at the annual expenses as a percentage of the fund's net assets, the advisory fee is 1.00% of net assets. Interest expenses from borrowing money come in at 0.09%. Other expenses add up to 0.24%. So in total, shareholders are looking at about 1.33% in annual expenses. This is quite important because when you invest in a fund, these expenses are a constant drag on your returns. Over time, they can really eat into your profits. For example, that 1.33% means for every $1,000 you invest, you are paying $13.3 in fees every year before even considering any market performance. This example helps put that into perspective. If you invested $1,000 and the fund made a steady 5% return each year, you'd pay about $29 in fees in the first year. Over 10 years, that bumps up to a hefty $174 just in fees, not counting any actual market gains or losses. It is crucial to remember that these are just estimates and actual expenses can vary. Currently, the fund has about 24.8 million common shares out there. If they manage to sell all the shares they're planning to up to $25 million worth, that would bring the total shares outstanding to over 27 million. Paid in capital would increase from around $265 million to over $290 million. This shows they are trying to grow the fund's assets. The fund expects to bring in about $24.6 million after all the selling costs. They plan to invest this money according to their objectives, which is to seek high current dividend income and long-term capital growth. They aim to invest it all within 30 days. If they can't invest it quickly, they might put it in temporary, safe investments, but this could lower their returns during that time. Here is a key point for investors. As of the 17th of November 2025, the fund's common shares were trading at $11.53 on the New York Stock Exchange, while its net asset value per S-Hair was $11.48. This means the shares were trading at a small premium to what they're actually worth on paper, about 0.44%. While that is good news for sellers, for new buyers, it means you are paying a little more than the underlying assets are worth. The filing mentions that shares of closed-end funds can often trade at a discount, so this premium is something to keep an eye on. There is no guarantee this premium will last. This section tells us how they're selling these shares. It is primarily an at-the-market offering, meaning they'll sell shares from time to time at prevailing market prices. The minimum price will be the net asset value plus the commission paid to the distributor. Alps Distributors Incorporated gets a 1.00% commission, and they pay up to 0.80% of that to UBS Securities Incorporated. The advisor might even chip in to ensure the selling price doesn't dip below NAV. This is pretty standard for this type of offering. This part is just a legal formality, telling you that other documents filed with the SEC, like their statement of additional information and annual reports, are considered part of this filing. It is like saying, Read these other documents too for more details. Back to expenses, this table confirms the 1.00% advisory fee. It also breaks down other costs. Interest expenses on borrowings are quite low at 0.09%, which is a good sign. One of the most interesting parts of this whole filing is how they detail the fees. For instance, the $0.02 per share fee for open market purchases in the dividend reinvestment and optional cash purchase plan might sound small, but it adds up for frequent traders. The example here shows for every $1,000 invested with a hypothetical 5% annual return, you'd pay $14 in total annual expenses in the first year, based on the breakdown in the previous table. But remember, this assumes no sales load or offering costs, which are separate. This table gives us a snapshot of the fund's financial structure. As of the 30th of April 2025, they had about 24.8 million shares outstanding with net assets around $262 million. If they sell all the shares in this offering, the number of shares would increase to over 27 million and net assets would go up to almost $287 million. The as adjusted column shows how the fund's capital would look after this offering, giving us a forward-looking view. Here the fund reiterates that the money raised will be used for investments, aiming for income and growth. They project that almost $24.6 million will be net proceeds. This is vital because it shows their intention to deploy capital and hopefully generate returns for shareholders. This is where we see the trading history. As of the 17th of November 2025, the fund had 24.8 million shares outstanding. The market price was $11.53 and the NAV was $11.48, a slight premium. It is crucial to understand that closed-end funds can trade at a premium or a discount to their NAV. This premium might mean new investors are paying a bit extra, but it also suggests existing shareholders have seen some appreciation beyond just the underlying asset value. This section elaborates on the at-the-market offering. It emphasizes that sales happen from time to time, and the fund and distributor have discretion over when and how many shares are sold. The key takeaway is that it is an ongoing offering, not a one-time big deal, and it is designed to add shares to the market as buyers are available. This table shows the fund's borrowings over several years. For the 30th of April 2025, their credit facility outstanding was about $18.3 million. The asset coverage ratio, which is how much assets they have to cover their debts, was a very healthy 1,530%. This means for every dollar they owe, they have over $15 in assets covering it. This is a strong indicator of financial stability regarding their debt. This is the basic background of the fund. It is a diversified closed-end management investment company started in 2006. Its investment advisor is abrdn Investments Limited. Again, they're reiterating that the money raised from selling new shares will be invested. This is crucial for investors to understand where their money is going and how the fund plans to generate returns. This tells us about the common shares themselves. They are listed on the New York Stock Exchange. Ticker symbol, AGD. The filing provides historical market prices and net asset values. For example, in July 2025, the high market price was $11.45 and the low was $10.04. The NAV high was $11.3 and the low was $10.54. Generally, the shares have traded at a discount to NAV, though recently they saw a small premium. This reinforces the point that market price and NAV aren't always the same thing for closed-end funds. The fund's main goal is to provide high current dividend income, with over half of it qualifying for lower tax rates. Its secondary goal is long-term capital growth. It invests at least 80% of its assets in dividend-paying stocks, both domestic and foreign. They can also borrow money, but they intend to limit this to about 10% of total assets. As with any investment, there are risks. The filing directs you to a separate section called Risk Factors for a full rundown. But generally, investing in any fund carries the risk of losing money. For this fund, specific risks would relate to dividend strategies, foreign investments, and the use of leverage. This section presents key financial data per S-Hair. For the 6 months ended the 30th of April 2025, the net asset value per common share grew from $11.15 to $10.55. After distributions, the total from investment operations was positive at $0.07 per S-Hair. However, distributions to shareholders were $0.67 per S-Hair, meaning the distributions exceeded the income and gains from investments for that period, which is why NAV slightly decreased. Looking back at fiscal year 2024, the total from investment operations was a stronger $2.18 per S-Hair, with distributions being $0.93 per S-Hair. This shows that performance can fluctuate significantly year over year. This table details the fund's borrowing, specifically its credit facility, as of the 30th of April, 2025. It had about $18.3 million outstanding. The asset coverage ratio is extremely high at 1,530%. This means the fund has more than 15 times the assets needed to cover its borrowing obligations, which is a very strong sign of financial health. Looking back, in 2018, they had no borrowings. This suggests they've actively used leverage in recent years. Just more background here on the fund's structure and its advisor, reinforcing again that the money raised will be invested in line with the fund's objectives. This details the trading history of the common shares. It shows the high and low prices, as well as the premium or discount to NAV for various quarters. For instance, in July 2025, the high market price was $11.45 and the NAV was $11.3, giving a premium of 1.33%. It is important to see these historical price movements to understand how the market has valued the shares relative to their underlying assets. This reiterates the fund's focus on dividend income and capital growth, and its strategy of investing in dividend-paying equities. This section discusses how often the fund buys and sells its investments. A high turnover rate, say over 100%, can mean higher transaction costs which eat into returns. For the fiscal year ending the 31st of October 2024, the turnover rate was 99%, which is relatively high but not extreme for 2023. It was 78%. This suggests the fund is actively managed. More detail on how they invest. The fund might invest up to 40 to 80% in foreign countries. They also mention focusing on companies with good dividend yields and the potential for earnings growth. This is where things get interesting. The fund can use options, futures, and other derivative strategies to manage risk or enhance returns. They can buy and sell put and call options on securities and stock indices. They can also write options, which means they sell them and collect a premium. This can generate income, but also limits potential upside. It is good to see they mention these techniques, as they are common tools for sophisticated investors to manage risk and boost returns. This is a critical section. The fund can borrow money up to about 1/3 of its total assets. While leverage can amplify returns, it also magnifies losses. The filing warns that using leverage involves special risks. They have a credit facility with BNP Paribas Prime Brokerage International Limited, and on the 30th of April 2025 they had about $18.3 million borrowed. The interest rate was around 5.39%. The fund intends to maintain a similar borrowing level but could increase it. This is something investors should pay close attention to. How much debt is the fund taking on, and are the potential returns worth the added risk? Here again, they emphasize that investing in the fund carries risk, including the possible loss of your entire investment. This section introduces the Board of Trustees and the advisor, abrdn Investments Limited. It details the compensation of the trustees for the fiscal year ending the 31st of October, 2024. The independent trustees earned between $16,000 and $21,000 from the fund, and a total of $300,000 to $600,000 from the entire fund complex. The interested trustee, Christian Pitted, who is head of closed-end funds for abrdn, is listed separately, and his compensation from the fund is not detailed here but is tied to his role within the company. This table shows the dollar range of equity securities owned by the trustees. Most of them own between $1 and $10,000 worth of the fund's securities, with the total within the family of investment companies being higher. Christian Pitted's ownership isn't listed here, likely because of his role within abrdn. This talks about the rules the fund and its advisor follow regarding personal investments of their employees, basically to prevent insider trading or conflicts of interest. This is important. It points out that First Trust Portfolios LP, First Trust Advisors LP, and the Charger Corporation collectively own over 3.9 million shares, representing about 15.84% of the fund's common stock. This makes them significant shareholders. More about abrdn Investments Limited and its parent company, Aberdeen Group Incorporated. They manage a significant amount of assets, over $504 billion as of June of last year. This outlines the deal between the fund and its advisor. The advisor gets paid an annual fee of 1.00% of the fund's average daily net assets. From May 2018 to June 2025, they voluntarily limited total operating expenses to 1.16% of net assets. This is a good sign that the advisor was trying to manage costs for shareholders. abrdn Incorporated acts as the administrator, managing the fund's day-to-day affairs. They get paid 0.08% of the fund's average monthly net assets. This identifies the service providers. State Street Bank and Trust Company is the custodian and accountant. Computershare Trust Company Incorporated handles dividend payments, transfers, and registrar duties. Here, they mention that the fund's portfolio turnover rate may vary. A high turnover rate means more trading costs. The rate for fiscal year 2024 was 99%. This gives specific details about common shares, including dividend reinvestment plans and voting rights. The fund has an open market share repurchase program allowing them to buy back their own shares. This can help reduce discounts to NAV. They can repurchase up to 10% of outstanding shares in a 12-month period. However, they have conditions like not repurchasing if it would delist the shares or impair their regulated investment company status. This shows a commitment to managing the share price relative to NAV. This is the big, dense section on taxes. The fund aims to qualify as a regulated investment company, or RIC, which means it generally avoids paying taxes on income. It distributes to shareholders. However, there are strict rules it must follow regarding income and asset diversification. Distributions of ordinary income and short-term capital gains are typically taxed as ordinary income for shareholders. Qualified dividend income and long-term capital gains might be taxed at lower rates. For non-US shareholders, there is a 30% withholding tax on most distributions. This section is really complex, and anyone investing should consult their tax advisor. This explains how the fund votes on issues at companies it invests in. The advisor votes proxies according to board-approved guidelines. They engage with companies and vote their shares in what they believe to be the client's best interest. This includes considering environmental, social, and governance or ESG factors. They use ISS as a service provider to help with electronic voting and recommendations. The whole appendix details their philosophy on things like board composition, executive pay, and sustainability. For instance, they might vote against a nomination committee chair if a board lacks gender diversity. This is a glossary of credit ratings from Standard & Poor's, Moody's, and Fitch Incorporated. It explains what ratings like AAA or BARBA mean in terms of creditworthiness. This is useful for understanding the quality of any debt instruments the fund might hold. This is a more detailed look at their proxy voting policies. They emphasize active ownership and engaging with companies to improve governance and long-term value. They have specific rules for voting on things like executive remuneration, board structure, and sustainability issues. It reveals a pretty proactive approach to being a responsible shareholder. Now, let's break down what this filing tells us from a big picture perspective. The abrdn Global Dynamic Dividend Fund is actively seeking to grow its assets by issuing more shares. They're managing expenses well, with a reasonable advisory fee and low borrowing costs, as indicated by that impressive asset coverage ratio for their outstanding credit facility. The fact that they're trading at a slight premium to NAV is a positive sign for current shareholders, although it could mean new investors are paying a bit extra initially. The fund uses sophisticated investment strategies, including derivatives and leverage, which can boost returns but also increase risk. So for potential investors, it is a trade-off between potentially higher returns and the inherent risks associated with leverage and derivatives. The detailed proxy voting guidelines show a commitment to responsible corporate governance, which is a good sign for long-term value. So what is the verdict? The abrdn Global Dynamic Dividend Fund appears to be a well-managed fund with a clear investment strategy focused on dividends and growth. The strong asset coverage on their borrowings is reassuring, and their active approach to proxy voting suggests they care about the long-term health of the companies they invest in. However, the use of leverage and derivatives, while potentially rewarding, does introduce higher risk. Investors should always do their homework and understand these risks before committing capital. Ultimately, the fund's success will depend on its management's ability to navigate market volatility and achieve its investment objectives. What is your take on these numbers and what they signal for the fund's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.